Hey, Adam Hoeksema here from ProjectionHub, and in this video I'm going to show you how to create financial projections for a tree service company. Now, my background, I was actually an SBA lender for 12 years, making over 1,500 SBA loans during my time as executive director of an organization called Bankable. And actually, a couple of the most successful clients that we had during my time there were tree service companies, and so I have some experience in the industry and lending to this space. And so one of the things that if you're trying to get an SBA loan, you're probably going to be asked for is a set of financial projections. And so I want to walk you through how to create a set of projections here for an SBA loan, or even if you're trying to raise capital from outside investors. We're going to walk you through that step by step. We'll put a link in the description of the video below so that you can grab this template and follow along. And then if you stick around to the very end of the video as a thank you for sticking around and hearing me talk about this exciting spreadsheet, then we're going to give you access to a discount code as our thank you to you. All right, so with that, let's go ahead and dive in to show you how this template works. Okay, so I'm going to start here on the At a Glance tab, and this is kind of the end of the process. So once you've filled out all of the assumptions, the projections, you're going to be able to see these nice different charts and graphs here that you can throw into a business plan or into a pitch deck. Now, some of the summary data here, this model is going to work for both residential and commercial type of work, and so I'll kind of walk you through that process. You're also going to get a 5-year income statement summary, 5-year cash flow summary, 5-year balance sheet, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. Now, in order to produce all of these reports, we have a little bit of work to do. And so we're going to start back here on this blue tab on our input assumptions tab. So the first thing you're going to want to do, put a projection start month. We're going to assume this is for a startup tree service company. And so starting cash balance is 0. We're going to assume that maybe you're putting in a personal investment of $20,000. Then maybe you have another partner that's going to put in $15,000 as well. If you're trying to get an SBA loan, you're probably going to have to put in some amount of equity into the deal. So typically maybe at least 10%, kind of a starting point. All right, the accounts receivable term. So we're going to set 0 for the starting receivables balance, again, because we're assuming this is a startup. We assume you have no receivables to start with, but this is the average days to receive payment. So this probably really depends on how much your work is commercial versus how much is residential. Residential, you typically get paid up front. Commercial, you might have to do the work, then invoice, then wait to get paid. So if you're heavy into commercial work, it could be 30, 45, maybe 60 days, depending on how big and slow your customers are. If you're on the residential side, it'd be much less than 30 days. So maybe we pick the middle, it's 30 days. And again, you can adjust that as needed. Now on the accounts payable terms, this is how long it takes you to pay your bills. So probably most of your expenses you're paying when you incur the expense, but maybe some expenses like fuel, you probably swipe at a credit card and then you have 30 days to pay that credit card, right? Or maybe you rent space. Again, maybe the landlord lets you pay with a credit card. You can kind of delay that payment. So that's what we're looking for here. This is probably going to be somewhere in the neighborhood of 0 days to maybe 15 days on average in terms of paying out your expenses. Okay, in terms of fixed assets, here's where we can add assets other than trucks. We have a section for trucks down below, but this would be an area where, let's say you did have an office. You may not need an office, but if you did, let's say you had an office space or even like a warehouse space or a storage space, and you wanted to do some improvements to the space. And so we did $10,000 worth of renovations or leasehold improvements to our space. That's what we'd be putting in here. And then here we can say, let's say $30,000 for maybe other tools and equipment. And we can set a life expectancy in years. So how long do we think that equipment will last? And then what do we think the salvage cost, or basically what the scrap value is after the 10-year life? So in this example, we just depreciated that down to 90%, down to the $3,000 salvage cost. You can set what month of the projections you're going to purchase these items. So for this situation, I assume all in month 1. Now, if you wanted to say, kind of build out projections into the future and say, hey, in year 2 or year 3, we're going to add additional equipment, that's where you could change this to say, month 25. So maybe the beginning of year 3, you add additional equipment, for example. You can do that too. Okay, so for the trucks here, we've got the ability to add trucks, pickup trucks, dump trucks or trailers, bucket trucks, right? You can set the truck value, again, how many years you're going to use it, and then what you think the salvage cost after the 10-year useful life. You can set when you're going to purchase that. So if you say 0, that means you already own it. If you say month 1, that means it's going to be cash pulled out of the projections, right? So in this situation, let's say you're starting the business, you've already got the pickup truck, and so you're going to just start using the pickup truck that you already own for the business. And then so we set that in month 0, but here we've got month 1 to purchase these new items. Now we can set an amount financed per truck. So here's how much of a loan you would have on each truck, and we set that as an equation. So it's taking the value times 0.9 or 90%. So we're saying you're financing 90%, 10% kind of as a down payment. So this would be if you're getting financing directly for the vehicles, like from the dealer maybe, and you can set the interest rate and terms on that. Now, if you're just getting financing as an SBA loan and not like a per truck financing or per equipment financing, then you could just add an SBA loan down here. So we've got an example here of $135,000 SBA loan at 10% over a 10-year term. Now in this situation, maybe we're going to use this SBA loan as working capital, and the equipment financing we're kind of doing separately. Well, maybe the SBA loan is going to help us cover these costs, right? The renovations and the $30,000 other equipment. So that's kind of the idea here. You could decide to just zero all these amounts out and use the SBA loan section down here for all of your financing if you'd like. Okay, let's move on to the revenue tab. So this is where most of the work is. As I'm going through this, you might be thinking like, this is overwhelming. It's too much detail for me, and I just want someone to fill this thing out for me or customize it for me based on my plans. That is a service that we provide. So feel free to reach out to us at support@ProjectionHub.com. If you're interested in having us customize and fill the model out for you, we can certainly help with that. Be happy to do that. But we try to make the templates flexible, powerful, but also the purpose of this video is to try to help you be able to do it on your own if you'd like. So let me keep kind of walking you through this. So on the residential customer acquisition side of things, we say, okay, let's assume that we have an advertising spend. So maybe we're doing mailers or maybe Google AdWords or Facebook advertising. And this is directly to residential customers. And so we've got a budget here. Maybe we spend $1,000 a month for the first few months and then have it go down to $500 a month after that. And then you have a cost per lead. So the cost per lead could be, or maybe you're advertising on like Angie's List, and you pay Angie's List and they charge you a cost for every lead that you get, right? And so you have some sort of cost per lead here, and that gives you a number of leads from paid advertising. Now you could also have organic residential leads. So maybe you're doing work at one house, you put a sign in the person's yard and the neighbor ends up calling you. That would be an organic lead, right? So hopefully we have some organic leads as well. And that gives us our total number of residential customer leads. And then we can set a conversion rate of leads to customers. So let's say we set that at 20%. So for everyone that reaches out, gives you a call, sends an email, fills out your customer support contact form, that sort of thing, the hope is, hey, we're going to convert 20% of them into new residential customers. So here's our new residential customers. And then we also have the idea of giving you the ability to have regular residential customers. So maybe you have an offering, especially for residential properties with a lot of trees, you might have some sort of regular ongoing kind of maintenance program. And so maybe every year you're coming out and doing some work on a regular basis. And so maybe you try to sign up some of those residential customers to become regular customers. And it could be they're signed up on some like formal commitment, annual or monthly type of commitment, or it could just be that some percentage of these customers are probably going to have work on a somewhat regular basis and they're going to keep coming back to you. And so that's the other thing that we're doing here is we're saying, okay, what percentage of those new customers become regulars? And then what percentage of those regular customers are going to churn or cancel, basically not be regular customers anymore? And so that's what we're modeling here, is the number of regular customers you have. From there, we're going to say, what is the average number of services purchased per new customer? Well, the new customers are all going to purchase something, right? That's why they're new customers, so they're going to purchase something. And then the regular customers are probably going to purchase less often. So we said, what is the average number of services purchased per regular customer per year? So we're saying 0.5. So in other words, 50% of these regular customers are going to call you back and purchase something from you every year. So based on those assumptions, here's our total number of services sold each month. And then you have the ability to put in your different service categories here, right? So we've got tree removal, tree trimming, land clearing, and whatnot, right? And then you can set the percentage of services sold. So of these 12 services sold, we're saying 50% is tree removal, 25% tree trimming and pruning, and so on. You can set the average price point, your cost of materials, and your cost of labor. You can set an annual growth rate in prices. So this is just kind of like maybe you're going to increase prices 4% a year, but that your material and your labor costs, maybe those are also going to increase at 4% a year. So maybe the plan is just to keep your margins steady with inflation. Okay, so that kind of calculates your residential services. But again, as I mentioned, we could have kind of a maintenance or membership or recurring revenue program. And so we can set how many customers are currently signed up for these formalized ongoing services. Let's say 0, but we're going to work to sign up some percentage of our new customers. So maybe 10% of our customers end up signing up, 5% of our existing customers. Maybe we're doing email blasts and trying to get those existing customers to sign up for this new recurring offering. So that gives you the number of new signups per month. Again, here's an annual churn rate, so annual cancellation rate, what percentage of those regulars are going to cancel. And then here's your monthly revenue per residential ongoing service customer. So again, this is probably really going to be for those properties, those residential properties that are expected to need your services on a regular basis. If they got a lot of trees, they want them to be trimmed and pruned, and you might set them up on some sort of monthly recurring. And then maybe as part of the benefit of this program, they also, if there's a storm, like maybe you come out for free for that because they're kind of like on this plan or whatever that might, there could be some additional benefits. And then you can set your cost of materials and your labor costs as a percentage of revenue. And so then there is your residential kind of maintenance program revenue and gross profit. All right, so now we're on to the commercial side. So we kind of go through the exact same exercise here, but for commercial clients. So you can have an ad spend for commercial clients. It's going to cost more probably per lead for commercial leads. So $200 cost per lead for commercial. Maybe you get some organic commercial leads as well. Maybe your conversion rate is lower. Maybe it's 10% on commercial deals. So it's all the same assumptions here. Your price points on commercial, because it's probably going to be larger properties, that these price points may be a lot higher. And so we've got these assumptions in here. Same thing, cost of materials and cost of labor. You've got your annual growth rate and prices. And then maybe more so than the residential customers that are paying monthly or on some sort of recurring regular basis, it might make more sense. You might have commercial customers that they would be willing to sign up for something like that. So you can offer this ongoing service. Now, if you're not going to offer any of that kind of like ongoing membership type based service, just put a 0 in here. So saying 0% are going to sign up for that. And then you can also put a 0 in here for the monthly revenue per ongoing commercial clients, and that will just zero out that whole section. So then the last thing we have that I want to point out on this page is a sales commission. So we have the ability to set a sales commission percentage for both the residential revenue and the commercial revenue separately. And then the rest of this is revenue calculation. Okay, so let's take a look at our operating expenses now. So you might have some expenses that are on a per truck basis. So like insurance, for example, you have vehicle insurance. You can select from this drop down what kind of expense it is. So you're actually able to set the expense categories up to 10 different expense categories up here. And those expense categories will then show up in the drop downs. So you can select your expense category and then select what the cost driver is. Is it a fixed dollar amount? Is it a percentage of revenue? Is it a per truck expense or a per employee expense? You can set all of those assumptions there. Now, maybe expense that we should consider here. So if we did credit card processing, and let's say your customers are paying you with credit card, we'll call that another expense, but that's probably a percentage of revenue. So we'd set that as maybe it's 0.03, or that's how we would enter in 3% of total revenue as a credit card expense. Okay, so on the salaries tab here, we can set an owner salary if you'd like. So if you want to have an owner salary, you also have administrative staff. Now, you also have the ability here to add employer taxes, benefits, and a start month. So let's say the administrative staff, you're not starting until month 15. Maybe you're kind of doing it all the first year, right? But then maybe you get some help in the office or administrative help in month 15, for example. Now, remember the labor cost on the jobs is really taken care of on the input revenue tab, where we're setting things like our labor cost as a percentage of revenue on the different jobs. So remember cost of labor over here. So we have set this, for example, we set that up as an equation. So it's taking the average price, taking the price times 0.25, so 25% labor cost. So that you'll see that all show up here in cost of material and cost of labor here for kind of the labor that's actually doing the work in the field. And then the administrative salaries are showing up down here in the operating expenses. Okay, so that is it. So I hope that's been helpful. If you have questions, again, feel free to reach out to us at support@ProjectionHub.com. If you need help filling this out, customizing it for your situation, we're happy to help with that. And if you found the video to be helpful, we'd love it if you give us a thumbs up and subscribe to our channel. Putting out a lot of content, helping people raise capital from SBA lenders or outside investors, and just helping through the process of projections, business plans, and ultimately finding that capital. So again, hope this has been helpful. If you have any questions, we'd love to hear from you. All right, thanks.